All right, so we are going to go ahead and get started. Good to see everybody, and welcome to our January market update webinar. I hope everybody had a great holiday season and a very happy new year. As you can tell, I'm flying solo tonight because Matt and Jenna both have other work commitments this evening, but Jenna did prep me on how to operate all of the technology, so we should be good to go. As a reminder, this webinar is being recorded and will be posted to our Jessup Wealth Management YouTube channel for people to watch it at a later date. As a reminder, as always, just a quick disclaimer before we get started. This is not financial advice nor a recommendation to buy or sell any investment products, and this is meant for educational purposes only. So I think I'm speaking for everyone when I say I'm glad to see that 2022 is behind us from an investment standpoint. 2022, in my opinion, will go down as one of the most challenging investment environments that really we've ever seen. And as I discussed in my January newsletter that went out, there were really very few places to hide. And in fact, 2022 was the worst year for the markets since the global financial crisis in 2008. Now on the screen here in the bottom right-hand corner, it's going to show the year 2022 and the performance, but this number was as of December 13th. So the S&P 500 actually finished down almost 20% for 2022. And the damage done to the markets last year feels worse because it hasn't happened in so long. Every few years, it is normal to have a pullback like this, but it just doesn't feel normal since it hasn't happened in a long time. We believe that markets and investors alike have kind of been waiting for this to happen and feel now that it is a positive, actually, that we got it out of the way and that we can move forward. So it was a really interesting year because stocks and bonds both got crushed along side with inflation raging throughout the country for most of the year. And it was the highest inflation that we've seen really since the early 1980s. And several bond indices actually had their worst year ever on record. And to put that in perspective, how bad bond returns were, prior to 2022, the Morningstar US Core Bond Index only had 2 years where it finished in negative territory in its history. And this data goes back to 1999. And both of those negative years saw bonds fall less than 2%. And again, to put that in perspective, in 2022, the Morningstar US Core Bond Index was down 16.7%. Interest rates also rose to levels that we hadn't seen since 2007. And, I think investors and consumers have questions as to how long interest rates will stay elevated and how long inflation is actually going to stick around. And one of the headwinds surrounding this topic, in my opinion, is the reversal of globalization after the COVID pandemic. So since COVID, the world has kind of been slowly moving away from globalization, and rightly so, because global supply chains were effectively broken. Everyone started to kind of realize that they need to start producing more goods in their own countries. However, one of the side effects of deglobalization is unfortunately sustained higher prices. I think we all know that goods can be produced at much cheaper costs overseas relative to the US. And if the number of companies making more product in America continues to increase, while that would be a really good thing for supply chains, I would imagine that prices will rise and be a little more sticky and stay higher for some time. And this is going to make it more challenging for the average consumer to keep up. And it's also going to squeeze corporate profit margins for corporate companies in America. But we do believe ultimately that we're kind of going to maintain this level of interest rates for the foreseeable future. And we don't think we're going back to the 0% interest rate environment anytime soon. Anything can happen, and we'll be prepared to make portfolio adjustments accordingly. But at least in 2023 and really 2024, I just don't see us going back to a 0% interest rate environment. But really, as bad as inflation was in early 2022, we're slowly starting to see the impact of the Federal Reserve's rate hiking campaign. So as you can see on the screen, commodity prices are well off their highs since June of last year. And one example I think that people can relate to is that inventories at retail stores have drastically risen since the squeeze during the pandemic. For an example, on Lululemon's most recent earnings call, they reported a substantial increase in inventory, which in turn will help lower prices so that they can move more product off the shelves, right? And this is not just happening at Lululemon. This is happening at most of the retailers that we all know and love. Some other examples like Target, Walmart, Nike, etc. So this is happening with a lot of retailers as inventory begins to catch up. And a lot of inventory is actually going to liquidation right now. So that just goes to show you how much product these stores have after they were catching up from the squeeze in the pandemic. This slide shows the month-over-month inflation rate, and it shows that it has continued to come down since last summer, and we expect this trend to continue at least into the first half of this year. CPI, the Consumer Price Index, key inflation indicator in this country, is due out this week actually for December. So we'll see if the trend continues month over month of inflation coming down. That's going to be a big indicator, in my opinion, of where stocks are headed next. And speaking of where stocks are heading next, hopefully we'll get a little more positive for everybody going forward and what we could possibly expect for the rest of the year in 2023. So we have several reasons to be optimistic for 2023. And the first is that we're in a year that we call a pre-election year. And stocks tend to perform extremely well in pre-election years relative to all other years in history. And performance tends to be especially strong in a pre-election year with a first-term president. And in addition to that, it's extremely rare for stocks and bonds to be down 2 years in a row. Really, since 1950, it's only happened in 1973, 74, and then the market was down 3 years in a row from 2000 to 2002 during the tech blowup. So we cannot rule out that stocks can finish the year negative this year. However, in our opinion, it's very far from likely. And according to a Carson Group study, the S&P 500 has been up 15% on average after a negative year and has ended higher 80% of the time. Moving on, stocks tend to bottom before the economy starts to get any better. So Matt and I have touched on this quite a bit over the past couple months in our podcast, in that the stock market is always forward-looking. And in our opinion, it's always forward-looking by roughly 6 to 12 months. So when we continue to see this negative economic data that's coming out, I think we're going to have a lot of people questioning if the market continues to move higher. Matt, this doesn't make any sense. The market's continuing to move higher, but the economic data just seems like it keeps getting worse and worse. But as you can see in the graphic on this screen, and the blue line represents the S&P 500, stocks recover before GDP, payrolls, and earnings. So the economy, right? And we don't believe this time is going to be any different. Like I said earlier, the poor economic data is going to continue. However, that doesn't necessarily mean that the stock market has to fall alongside it. The market's always forward-looking and pricing in events in the future and not in the present or in the past. And one of these indicators that I think you're going to see continue to get worse is the unemployment number. So the labor market has been extremely resilient through everything that we dealt with in 2022. But I would expect the unemployment rate to rise as we are starting to see more and more companies announce job cuts and layoffs and hiring freezes. So that's a theme that I think you're going to see in 2023, at least in the first half, that unemployment is going to go up. But in my opinion, I still think we're going to have a relatively good year for the market. And also, as we've discussed on the podcast recently, we like to kind of follow these three indicators that were created by a gentleman by the name of Yale Hirsch that can give us insight into what the full year will look like for stock market returns. So the first out of the three indicators is something we call the Santa Claus rally. So this indicator measures the performance of the S&P 500 the last 5 trading days of the year plus the first 2 trading days of the new year. And when the performance over that 7-day period is positive, we like to say that Santa came to town for that year. Second indicator is the first 5 days of January, and this indicator is pretty self-explanatory. It just measures the performance of the S&P 500 during the first 5 trading days of January. And last but not least is the January barometer, the third indicator, and the January barometer measures the performance of the S&P 500 during the full month of January in the new year. And by examining the data from Yale and Jeff Hirsch surrounding these indicators from their yearly Stock Traders Almanac, we can extrapolate the following conclusions. The first that stands out to me is that since 1950, when all three indicators were positive, the S&P 500 finished up 28 out of 31 years, which is 90% of the time, with an average return of 17.5%. The second is that since 1950, when the Santa Claus rally and the first 5 days of January are both positive and the January barometer is negative, the S&P 500 is up 9 out of 12 years with an average return of plus 6%. And this year, from what we know so far, Santa came to town the last 5 trading days and the first 2 trading days of the new year were positive. And the first 5 days of January were positive as well. So we're now waiting to see how the month of January plays out for that trifecta indicator that has a 90% hit rate with an average return for the S&P 500 of 17.5%. And, obviously as a disclaimer, we never like to take any indicator as biblical. However, these 3 indicators do a pretty good job of giving us an idea of where the market will go in this upcoming year. And the data is even more useful when the market doesn't behave and act in line with its historical norms. So either way it goes, how we finish the end of January, it's going to give us a really good data set to make certain adjustments to client portfolios over the course of over the course of the year, to see how this market and this economy will play out over 2023. So with that being said, final comments before I open it up for questions. If anyone has any questions, again, this is going to be recorded, so people will be able to go back and listen to this on our YouTube page at Jessup Wealth Management. And Jenna will go ahead and get that uploaded sometime later this week. We do believe that 2023 is going to be a better year for the markets and for investors than it was in 2022. I know it's not easy to go through a year like we did in 2022. However, like the data shows that we talked about a little earlier, this does happen from time to time. This has happened several times in the past, and this is going to happen again in the future. Now, the reasons why the stock market is going to sell off in the future, they're going to be different. But we are going to have more years when the stock market is down 20%. That's just the unfortunate byproduct of getting and generating the long-term rates of return that we get in the market over a long period of time. But Matt and I both do believe there are significantly more tailwinds going into 2023 than there were going into 2022. As always, we will make portfolio adjustments as necessary with the data that continues to come in. And I hope that everyone has had a really good start to 2023 and wish that everyone has a safe, happy, and healthy year. So with that being said, I'll open it up for questions if anyone has any questions at this time. Okay, well, I think that'll do it then. Just had a few of us on the call tonight, so thanks for joining. Again, if any questions, comments, concerns come up, don't hesitate to reach out to us. Our team is ready and able to assist with anything that anybody might need. So I hope again that everyone and their families has a happy, healthy 2023, and please reach out if there's anything that myself or my team can do to help get you through the new year. So I hope everyone has a great night, and we'll talk soon.